Hello. Um, Thank you for joining our NvestNus presentation. My name is Valentina,
And I'm Wyatt.
and we'll be talking about the accounting scandals and, most importantly, the Sarbanes-Oxley Act that was enacted because of them. So, a brief overview of what the Sarbanes-Oxley Act is. It's a federal act passed in 2002 as a response to accounting scandals during the late 1990s and early 2000s. These accounting scandals that caused really large corporations to fail also caused a significant uproar in the economy and led to a lot of economic distress to a lot of normal people, not just investors, but also customers and people that had their retirements invested in these companies. So it was a really big deal. And finally, SOX, which is just Sarbanes-Oxley, that's the abbreviation used. SOX created regulations to help protect investors from um, any other like misrepresentations of companies, as we saw before, because it improves the accuracy and legitimacy of corporate disclosures, such as their 10Ks, for example, like their annual filings.
Okay. So there were a number of accounting scandals, as we kind of just talked about, that led to the creation of Sarbanes-Oxley. So the first one, and really the big one, is Enron, and we'll talk about that more in the PowerPoint. Then another company was WorldCom, then Tyco International, Adelphia Communications, which we'll talk about, and then Peregrine Systems. So the first company that we'll talk about is Adelphia. So Adelphia Communications is actually a local, well, was a local company in our area. They were headquartered over in Coudersport, PA, so about a half hour away from here. So basically, it was a family business made up of the Regas family, and they used personal loans, or excuse me, they gave personal loans to management. They manipulated their financial performance, they inflated their stock price, and they falsified revenues. And they did so many things wrong with this company that um, we can't really go in depth in this PowerPoint, or we'll be here for a while. So an important thing is that the Regas family took about $2.3 billion in personal loans from the firm while the financial performance of the company was manipulated. They misrepresented, or excuse me, they were misrepresented. Sorry, I'm like, um, the financial performance of the company was misrepresented by upper level management, and the problem with their management was that it was mostly family members. So the stock price was deliberately inflated in due part for the Regas family using the money borrowed from the company to buy more stock in their company. It just was a hot mess. Um, so over here, this little graphic shows kind of ugh, shows their reported liabilities that they reported on their financial statements compared to what they actually were, because they lied by quite a bit. They underreported a lot of their liabilities. So that's bad. And then a fun fact about the Regas family is that they used money, this like illegal money, to buy the Buffalo Sabres. So I find that interesting. Um, so what were the consequences of the fraud committed at Adelphia? Well, the Regas family was investigated and they were removed from the business. They were investigated by the SEC and the Justice Department. John Regas, the CEO, was they had to, they settled for $2.18 billion, which was about 95% of their assets. John Regas and his son Tim were also sentenced to 15 to 20 years in prison, though they did not go to jail actually until 2015, 2011, and this actually occurred in 2002, I believe. So quite a gap. And then John Regas was released from prison in 2016 after he was diagnosed with terminal bladder cancer. Even though he didn't die until September 30th, 2021. So he really got lucky. So then the company fell apart after that. As you can see, like this graphic is their stock price. So it was pretty high in March of 2002. And then by summer of 2002, their stock price was just completely diminished. And then the company delisted from NASDAQ, and then it was sold to Time Warner and Comcast. So in accounting, we have these things called internal controls. So where did Adelphia's controls fail? Well, two main failures were their external audit. That was all messed up. And then they had internal control failures. So the external audit issues, so Adelphia's auditor was Deloitte. They're one of the big four accounting firms. They admitted to having a lack of objectivity with respect to Adelphia's audit. In addition to the lack of objectivity, the auditor failed to notify the audit committee about questionable accounting practices and self-dealing. So a lot of this could have been prevented if the auditor raised the red flag that they noticed, but they just ignored it. So investors really were hurt by this powerful impact of the company failing. And then I won't talk too much about the internal controls just because there's quite a bit that went wrong. But 5 of the 9 board members of Adelphia were Regas family members, and they owned 100% of voting shares in the stock, which meant they had majority voting rights. And about $2.3 billion of the firm's debt was recorded on the balance sheet because it was co-signed by the Regas family members, and expenses often were booked as capital expenditures. And they also lied about the number of subscribers. I don't think I said that. Adelphia was a cable company, so they lied and made it seem like they had more people subscribing to their cable services when in reality they didn't have that many, well, as many as they reported.
So I'll talk about Enron, and you might have already heard about this case because it's one of the biggest reasons why SOX exists. And it was probably the biggest downfall and the most like scandalous of all of them because of how they committed their fraud and how much money they stole. Also because it was such a huge company. Enron is an energy company. If you didn't know that, they traded extensively in energy derivative markets, which derivatives are a financial instrument that you can buy and sell and trade just like kind of like stocks, but they're really complex and they're sort of like I don't know how to like explain them really quickly, but they're just like kind of made up. But it's a different way of trading. And since they were such a large and reliable company, I believe it was the entire New York State teacher pension fund was entirely invested into Enron. So when they collapsed, all the teachers lost their retirement money, which was a huge deal. But in regards to the fraud that they committed, they were using fraudulent accounting practices to inflate the company's revenues and also decrease or like hide some of its debt and liabilities as well. Basically, also what Adelphia did. But the way that Enron did this was really not seen much before. They were using subsidiaries in order to hide the debt, and also take out loans with a really good credit rating from major banks like JP Morgan. The main issue with Enron is that because the SEC, credit rating agencies, and even investment banks were all like, and private accounting firms, they were all sort of like encouraging this fraud to continue because of their negligence and in some cases like even outright deception. So they would help perpetuate this fraud. Um, but basically, senior executives at Enron engaged in a scheme to manipulate their financial statements by using sort of like a Ponzi scheme, if you've heard of that. They would manipulate their financial statements so the company looked really trustworthy and profitable. And then so that would encourage investors to put money into it. And this would like help pay off some of their liabilities. But most of that money would get stolen. So they would have to like keep inflating their financial statements in order to get more investors. They also made false and misleading public statements about its performance, which led to many more millions of investments, such as like this teacher's retirement fund. And they also one of the biggest accounting practices that they utilized to like misstate their statements were mark-to-market accounting, which since 1992 they were engaging in. Basically, it means that any investments that you make in assets that will provide or will generate like a regular cash flow, you can add on to the fair market value of that investment that you bought because it's going to generate a lot of profit in the future, so it's worth more now. That's with mark-to-market accounting. With normal accounting, you can't do that. You have to state the asset at whatever value it actually is. So this gain in the asset was recorded on the income statement, which increased their assets, and also their cash from operations. So this was like doubly wrong. I guess we can go to the next slide then. This is a chart of like all of the tools that they use to perpetuate this fraud. Their use of special purpose entities, SPEs, was not new for the time, but like not many people were doing it. So basically what they would do with these special purpose entities is they would dump all of their liabilities and all of their debt onto like an SPE and then book all the revenue on like Enron main books. They would also manipulate asset values with mark-to-market accounting, like I discussed previously. They would also discuss loans as asset sales. So this is how they kind of got involved with JP Morgan and another bank. Maybe it was Barclays, I'm not sure. But they would basically have, and there's a better chart that shows it later on, but they would ask, like they would use one of their SPEs to ask for like a loan from JP Morgan at a certain rate. And then that SPE would sell it to Enron, and that sale was booked as an asset sale. Concealing the failures of its subsidiaries, all of these subsidiaries that they thought were going to generate a lot of money and weren't. They were failing, and Enron was like cutting them loose from the main corporation before it got onto their books. And that's how they were concealing these failures. They were also using improper use of reserves because they were an energy company, so they had reserves. They misused prepays. Again, sort of with what I was saying about the loan sales, they did something really similar with prepaids. Also failure to disclose goodwill impairment and false and misleading statements. That was the culmination of all these acts. And then on the next slide, we have the special purpose entity chart. So these SPEs are basically a subsidiary created by a company that has a narrow or very specific or even a temporary objective that they want to accomplish. So they would purchase these SPEs with the intent of letting them run for a few years or for a specific project, and then that would get to book all of the expenses and all of the sales. But since they weren't doing really well, they would just like get dumped with loans and debt, and then all of the revenue that they generated would go to Enron's main books. So you can see in the chart, sorry, the last slide. No, my bad. The originator, which would be Enron, would like would get their SPEs to like sell them assets, in other words, like revenue or like income generated from operations, and they would like dump all of their like management would dump all of their like loans and debt and stuff like that. Generally, they were used to isolate a risky venture so that it had very little negative impact on the parent company and its investors, because when you start a project, your first few years are generally losses that you would book. And so it makes it seem like the parent company is failing, but in reality, it's just starting up a new venture. So in order to minimize that negative impact, they would open up a ton of SPEs. And this is legal, by the way. The way that they were using it was just unethical. Okay. Yeah. And then this is also what I was talking about, the disguised loan with JP Morgan, how JP Morgan would lend Mahonia, which was like an SPE for Enron, and then Mahonia would sell this loan to Enron as a prepaid for gas that they were never gonna get. And then there was a third layer, which this gets really into the nitty-gritty of it, and it's really not that important to like understand what they were doing. But Enron's executives artificially inflated the book values for certain assets in order to generate earnings and meet budget targets. But many of Enron's interests weren't publicly traded, so that's why they had their own internal valuation models to determine book values. And this is where mark-to-market accounting comes back in, because they could just say what book values they wanted, and this would like increase um their assets on their balance sheet. And this was not public knowledge. Like the public had no way of determining how or why Enron's assets were so big. And they just had to trust that Enron was doing a good job at evaluating them, which clearly they weren't. Um, and I already explained how Enron disguised its loans. Oh, they got financial institutions, JP Morgan and Citigroup, to invest in their SPEs without knowing it. And that's why a lot of people say that these really big capital investment banks were perpetuating this fraud because they were falling subject to Enron's like disguises. Also, Enron has subsidiaries such as EES, which is like Enron Energy Savings. This is where they booked a lot of their like bad loans and uncollectible receivables, which is when like a customer says that they'll pay you back for what they're receiving, but they never pay you back, so it's a loss. Okay. And basically they made a lot of like misleading statements to the public and to the government, both through their 10K filings, like their annual report, and also tax documents. But this, like, they would do this they would hold conferences and employee meetings. So even the employees that worked at Enron had no clue that their company was failing, and they were even encouraged to like put their retirement, their 401k that the company was giving them as part of their benefit package into Enron stock. So this only perpetuated their Ponzi scheme as well. They would also hold conference calls, press releases, interviews. The SEC allows you to like make notes and like make disclosures for like your company. And they would do this with the SEC. They would say that their company's doing great and they have like all these investments that were likely to be profitable, but really they were already failing. So this is just how they got away with like this is how they kept it on the low for so long. Eventually it all comes to an end, and Enron filed for Chapter 11 bankruptcy at the end of 2001. And by that time it owed creditors $67 billion with a B. Enron's collapse resulted in a loss of $74 billion in shareholder losses over 4 years, leading up to the collapse. And shareholders filed a $40 billion lawsuit and received two separate settlements for 4.2 and 7.2 billion, which in the grand scheme of things is not a lot of money because they lost so much more. In addition to this, Enron was a huge company and thousands of workers lost their jobs and retirement funds, which were invested in Enron stock anyways. 20,000 Enron employees sued the company for their lost retirement funds. But each employee received only about $3,100 like total. So if you end up investing in a Roth IRA, you're supposed to retire with, I don't know, like at least thousands of dollars. Most people retire with like hundreds of thousands of dollars. They only received 3,100, which is horrible. Um, in the next slide, I'll talk a little bit more about the accounting implications with the Enron scandal because it took down one of the big accounting firms. Called Arthur Andersen. So if you're familiar now, we have the big four accounting firms, EY, PwC, Deloitte, and KPMG. Well, before there were five. The fifth one was Arthur Andersen, which did the books for Enron. And Enron was such a shock and such a like horrible like tragedy that happened that people started to look for where it went wrong and where we could have caught this mistake before it got too big, like it did. And a lot of people blamed Arthur Andersen because they were the ones that were like approving of the books of like the statements that they were filing. And like Arthur Andersen actually was the like external auditor, the CPA firm that signed off of a lot of like financial statements that were wrong. So you can see here some of the other big names that we mentioned at the beginning: WorldCom, Enron, Peregrine Systems. I think Sunbeam was on there too. You might know Waste Management; they're still active today. But these were like a big ones, like big companies that Arthur Andersen approved, and their financials were all wrong. So the final nail in the coffin was Enron, and Arthur Andersen was ended up being convicted of obstruction in 2002. It was later found that they were shredding and doctoring documents related to Enron's audit. And although the conviction was overturned in 2005, the firm's reputation never recovered, and it ended up splitting into like two companies. I forget their names. I mean, well, it lost its CPA license. It was never like able to function like that again. But like out of Arthur Andersen, another company formed, which was Accenture. And I forget the other one. But yeah, this like, and this is why like when we talk about Sarbanes-Oxley a little bit more later on, you'll see like why they're so tough on the CEOs and the accounting companies that audit their financial statements.
Sorry. All right. So let's talk a little bit more about SOX. So as we said earlier, SOX was a law that was passed by Congress as a result of all of these accounting scandals, especially Enron. They were like the nail in the coffin that finally Congress is like, all right, we have to do something. So they passed the Sarbanes-Oxley Act in 2002 as a response to the accounting fraud that was rampant in the 1990s and early 2000s. The bill states that it is an act to protect investors by improving the accuracy and reliability of corporate disclosures made pursuant to the securities laws and other purposes. So SOX applies specifically to publicly traded firms and the accounting firms that audit them. It aims to improve the client's firm's internal controls and the accounting firm's external audit procedures. So here's like a timeline of SOX. So in 2000, the dot-com bubble burst. That's basically the birth of the internet. Then 2001, 2002, Enron, WorldCom, and Tyco, they all faced their fraud charges in those years. So 2002, Congress passes Sarbanes-Oxley. And then in 2021, they kind of like amended SOX a little bit and added to it. And now IT departments must ensure compliance for financial files and records because so much of accounting data is done online now rather than paper files. Whoops. Okay. Can you still see the screen?
Yeah, all good.
Okay, perfect.
So the effect that SOX had on public companies was huge. It basically like uprooted a lot of like the old rules that were allowing these frauds to continue. And it created a lot of new rules that we still use today and that have to occur for firms to keep their CPA license. So the Sarbanes-Oxley Act specifically created the PCAOB, the
Whoops.
Public Company Accounting Oversight Board.
Sorry.
And it also like required the independence of auditors. So one of the main issues with Arthur Andersen and why they were indicted as well is because they, on the one hand, so CPA firms have usually three main functions. They can either audit, they can do tax work, or they can do consulting work. And consulting is more internal with the company. They tell you like what's wrong and how to fix it. And Arthur Andersen was doing both audit and consulting work for Enron. And obviously, if you're auditing a firm that you're helping manage, you're not going to find many things wrong with it. So the lack of independence with auditors really was like one of the things that people wanted to like focus on and like fix. Also, corporate responsibility. From now on, the CEO and CFO were required to sign off on the financial statements saying that they were legitimate, correct, that like nothing illegal was happening. And this is huge because back in the day, they weren't like required to do this. So it was really hard to convict like CEOs and CFOs of like this like massive counts of fraud because they could just claim ignorance. And they could just say, oh, I didn't know this, I didn't like look into this closely enough. But now with their signatures, they also found that companies took a lot more time in getting their financial statements done because they were looking at them more closely. So it helped companies also have a better like handle on their financials. Um, also enhanced financial disclosures. Companies were now like they had to like put in notes, like footnotes in the financial statements saying where this number came from, or like just like explaining a little bit more of their financial statements so the public had a better idea of like what was going on, the public and investors. Also corporate and criminal fraud accountability. This goes back to the CEO and CFO getting convicted on like fraud charges. Also white collar crime penalty enhancement back in the day, like before Enron and these other scandals. I think the like maximum sentence for a white collar crime was like 5 years, and it got bumped up to 20, I think, if not more, but I think it was 20. Also corporate tax returns had to be audited as well, and they had to be like done by a CPA firm. And there was another restriction that was placed upon corporate tax returns as well. And they had like harsher penalties as well for obstructing an official proceeding, which is what Arthur Andersen got convicted of.
Okay. So there are many sections of SOX. So these three sections are particularly important for external auditors. So I'll briefly summarize them. So Title II is all about auditor independence. And basically what that means is that the external auditor is not allowed to perform specified non-audit services for a firm while serving as the firm's auditor. Any services not expressly forbidden by SOX must be pre-approved by the audit committee, and they need to be disclosed to investors. The audit partner must report directly to the audit committee, and they must be rotated off of the engagement every 5 years So basically what that means is that you need somebody else to do the audit. You can't just have somebody continuously doing the audit because you could like slip them some money or something or do something shady. And that's basically what these companies did. Section 404 basically sorry. Section 404 is all about internal controls. So annual reports must include an internal control report that states the management's responsibility for the internal control and evaluates the effectiveness of the firm's internal controls. And then the external auditor must attest to and report that the assessment and must report on the assessment of the claims made by the firm. So basically, the business will like write up a list of what their internal controls are, and the auditor has to look at that. And then basically they'll sign off saying, yes, this is true. The company has followed these internal controls. And then section 802 is the retention of audit documents. It basically says that the SEC will regulate the retention of documents related to the audit or review, and basically it establishes criminal penalties for knowing and willfully violating these regulations. So I believe audit documents have to be kept for like 10 or 15 years after. So if you destroy the audit documents, you're going to get in trouble. There's going to be some legal consequences for doing that. And that's basically what Section 802 defines. Then these sections are particularly important for the client. So Section 302 basically states that executives must certify financial reports and internal controls. So basically the CEO and CFO, they're personally responsible for assuring the accuracy, documentation, and submission of all financial reports. So they have to say this is done correctly. If not, it falls back on them. Section 402, companies can't extend personal loans to executives. So Adelphia and Enron both were famous for doing this, giving personal loans to executives. So this just makes it where they can't do that. Section 404, which I kind of just talked about, is the one where the management must report on the effectiveness of internal controls. And then Section 407 established an audit committee, and an audit committee must have a financial expert on it. So the firm must disclose whether it has at least one financial expert on its audit committee.
Okay, so who created it was Senator Paul Sarbanes and Representative Michael Oxley. They were the two co-sponsors of the act, and obviously the namesake. What was really interesting about this is it passed unanimously. Actually, I thought it passed unanimously in the Senate and almost in the House of Representatives, but it won by a landslide. Because this bipartisan piece of legislation was at the time seen as really, really important to like the financial well-being and health of public companies and like the economy in general, because obviously it has a trickle-down effect and it affects everyone. So it was signed into law on July 30th, 2002.
Okay. Sorry.
Go ahead.
Who it protects. So basically, Sarbanes-Oxley, the whole purpose of it is to protect anyone who relies on financial statements to make decisions. So that goes for the company itself, investors. We talk about this a lot in NvestNus. We're constantly looking at the financial statements. The last video was all about analyzing the 10K and you guys use that for your stock pitches. That's really important information. So if that is not accurate, then you have a problem. You don't want to be investing in a company that is inflating its stock price and manipulating everything, because that's obviously bad. That's going to be bad on your investment. You're going to lose money and you're going to get hurt with that. So again, investors, you have to require that the financial data presented to them is correct. Employees of the company, Enron, they all lost their pension because of it. Oops. Oh, well. Okay. So, okay. The next group of people it protects is accounting firms. So basically it made regulations for accounting firms, which helped them in the long run, because Arthur Andersen collapsed because of their misdoings. And then the last one is banks. It helps banks, kind of similar to investors. Banks might, if you want to get a loan from a bank, they rely on the financial data or the financial statements. So it helps banks from trying to. I'm sorry, I'm just having a mind blank.
You're good.
Yeah, so you guys get the point. All right. So
Well, thank you so much for listening to our presentation. We hope it was helpful. And if you have any questions, be sure to bring them to class and we can discuss them later, or like on Friday when we're there.
all right, see you guys.
Bye. Oh, that is so cringy.
You didn't stop the recording yet.